Did you guys know that two different people with the same pre-approval amount can have two different mortgage payments? Now in this video, I'm gonna break down the mortgage payment for you, which is in 4 different parts: your payment, interest, taxes, and insurance. Let's go. What's up everybody, this is your boy Jacques. If you're new to this channel, I'm a licensed realtor and mortgage loan originator in the state of Florida. Now my goal on this channel is to help you gain wealth through real estate and also help answer any of the questions that you have. And this week we're going to be talking about your mortgage payment, which is divided into 4 different parts. Now you might not be aware of this, but your mortgage payment can be drastically different depending on where you stay. Now I'm in Florida and I have a lot of friends that moved to North Carolina, Connecticut, a lot of different places in the US. And with the same pre-approval amount that they have there, it would not be the same if it was down here. Now with this video, I'm gonna break down the reason why and explain to you how to find the right place at the right location can help you. Now stick around and watch the whole video because I'm gonna break down a mortgage payment for you, and also I'll give you some tips to bring that mortgage payment down even further. Now I know you're probably wondering why 2 different people can have the same pre-approval amount, have 2 different mortgage payments. Well, I'll go ahead and explain it. Your mortgage payment is broken down to 4 different parts, which is your payment, interest, taxes, and insurance. So I'm gonna go ahead and break down the first part, which again is your principal. So your principal, mortgage principal refers to the outstanding balance of your mortgage. So it's basically what you owe remaining on the home. Now if you owe $200,000 on the home and you put $10,000 down, you basically owe $190,000 left over. Now with that, divided by 30 or 15 years, depending on the type of loan that you have, basically that will be the remaining principal of your loan. So basically the more money you put down, the lower the principal portion of your mortgage payment will be. So this part is very crucial. If you put a minimum payment down, you're gonna come out with the maximum amount on the principal side. So again, the more money you put down, the better, because it's gonna ease up on this portion of the mortgage payment. Now the next part of the loan is your interest. Now this part plays a huge factor on how much money you spend on the total life of the loan. Now with this, basically it depends on a couple of factors, since that's the current market value at that time and also the current borrower on the loan middle score at that time. So again, if you and your friend have the same pre-approval amount, they might have a better credit score, which might actually drop their mortgage payment just a few bucks less than yours. That's one reason why you might have a different mortgage payment amount. Another thing, and this happens a lot with my buyers, is that some people actually buy down their loan. So basically when you buy down the loan, you're basically paying the bank ahead of time a certain amount to get their interest rate a little bit lower, so that way they don't pay as much interest throughout the life of the loan. So the bank gets their money up front and the borrower saves money in the long term. Now the next part, which is your taxes, play a huge part of your mortgage payment. Now again, I'm in Florida, taxes are a lot higher down here than what they are in different places of the country. So with that being said, taxes are also included in your mortgage payment. And also, if you're in 2 different counties in Florida, your taxes and mortgage payment will be drastically different. Now, if you're a potential home buyer or you're out in the market right now, I'm sure you realize that with the pre-approval amount that you have, 2 homes with the same pre-approval amount in 2 different counties or 2 different locations, mortgage payments are drastically different. Now already you see how your mortgage payment can differ already just by the 3 things I went over. Your principal, again, depends on the type of home that you buy and how much it costs. Also depends on how much money you put down. The more you put down or the more house that you buy can affect your mortgage payment on the principal side. The interest portion of your mortgage is depending on if you buy the interest up front and pay it down, or how high you got your credit score on the time of approval. Taxes, again, depending on the location and state that you live in, the taxes can vary and also cause a huge impact. The amount that you pay in taxes is based on 2 different things: your local government's tax rate and your property assessed value. Basically, all you have to do is take your home's assessed value and multiply it by the tax rate. Now, I know you guys are probably not just coming straight out of high school to buy a home. If you are, I congratulate you. If not, I'll go ahead and drop the math right there on the screen. So basically, it's your assessed value times your property tax rate, which equals your property tax. Now, I don't know how they came up with that. That's for another video, but I just want to break down that your taxes are important, which is already included in your mortgage payment. Now, lastly is your insurance. Just like your taxes, your insurance plays a huge part in your mortgage payment. Are you in a place that has a lot of natural disasters such as hurricanes? Maybe you're in a flood zone, or maybe you're in an area that has a lot of claims and the people that are making the claims are bringing the insurance up. Either way, your insurance is a huge factor when it comes down to your mortgage payment. And also, just to throw it in there, if you do end up buying a townhouse or a condo, you might have what's called a HOA, a homeowners association. Now, the HOA is not included in your mortgage payment. Yeah, the lender might include it as the total amount that you might have to pay. It is a separate payment that has to be paid to the association. So with that being said, your HOA is another reason why your mortgage payment can increase, because HOAs are mandated by the association and those fees can change as well. Now, I know that was a lot of information, but at least now you know what the mortgage payment consists of and why the payment may fluctuate with two different people in two different locations. If you have other questions, make sure you check out my home buying tips. I don't know if it's here or there. I always get confused. I think it's up here. Make sure you check them out. And every single week, I'll be uploading more videos of questions that you guys have. Now, the question for this video is, what questions do you have about real estate or mortgages in general? I'd love to know. Drop your questions in the comment section, and I'll make a video out of it. I hope you guys got some valuable information out of this video. As always, make sure you smash that like button, guys. Make sure you subscribe to my channel if you haven't done so already. I'll be dropping videos every single week for you guys. Make sure that notification bell is on so you guys will be the first ones to comment and watch the video. And as always, I appreciate you guys watching this video. I'll see you guys next week. Have a great day. Have a great week. And I'll see you in the next one. Peace.